The benefits of investing in stocks. Why you should consider stocks investing in the stock market. Are you tired of letting your hard-earned money sit in a savings account, earning next to nothing? What if we tell you there was a way to potentially grow your wealth while also taking advantage of the power of the stock market? In this video, we'll reveal the shocking benefits of investing in stocks and why you should seriously consider making your money work harder for you. Why should you invest in the stock market? Most of the time, it is hard to predict the stock market's movement, but the benefits of investing in equities remain constant. What has changed or must change is the public's understanding of the stock market and the risks it entails. Consider the reasons why stocks remain a viable investment and why you should invest in the stock market, in addition to putting some of your available cash into a savings account. Investing is less expensive than you thought. Investing in the stock market is a tried and true method of making your money work for you, but you don't have to spend thousands of dollars to get started. Start by putting aside the few dollars you would normally spend on a daily latte and investing the difference in stocks or an index fund. It's a relatively straightforward way to put your money to work for you in the future. This is especially true now because you don't need a lot of money to begin. Many investing platforms allow you to buy fractions of a unit of a stock in a company you like, a process known as fractioning. Many robo-advisor and investment applications have low or no fees or expenses, making it easy to get started. Sounds interesting? A dividend reinvestment plan is one of the most prevalent types of investments for new investors. It's called DRIP. DRIPs are shares that automatically reinvest dividends by purchasing additional shares. DRIPs can save you money by eliminating the need to pay broker fees for transactions because the shares are repurchased directly from the entity that offers them. Your stock holdings and earnings compound and grow at an accelerated rate over time. DRIPs take advantage of the power of compounding interest without requiring extra funds from you. How to overcome inflation. Inflation, or the gradual loss of a currency's purchasing power, is not your friend when it comes to saving for a large purchase, acquiring a home, or financing a happy retirement. Assume that the Federal Reserve seeks to keep inflation at a below 2%. Consider how this may affect the purchasing power of money in a certificate of deposit, CD, or savings account. To keep up with inflation, each account or investment must earn at least 2%. However, even high-yield savings accounts do not provide such high returns, and CDs typically pay greater interest rates than savings accounts, and you may even be able to keep up with or slightly exceed the target inflation rate. However, your money is locked up for the duration of the CD, which can range from 30 days to 10 years. And one more thing that you should keep in mind, that if you have to take your money before the end of the CD period, you will be charged an early withdrawal penalty, which will reduce your gains even further. Increase your wealth. So have you decided to invest in stocks to increase your wealth? Then keep in mind that there is no assurance that your stocks will perform well. To get a decent return, you don't need to invest in the next Amazon or Apple. Consider that according to the S&P 500, the stock market has averaged a 10% yearly return on investment. This is despite the stock market's volatility and inclination to fluctuate quickly, which occasionally ends in a historic crash marked by a sudden double-digit drop in value. Invest in a variety of assets. Diversification is one more tool that you can use in this battle. Diversify your portfolio by including some stocks in addition to bonds and other fixed income securities. CDs and savings or money market accounts can help insulate you from the inherent volatility of the financial markets. When the stock market falls, the bond market rises and vice versa. This comes down to being able to better control volatility, also known as risk, by wisely investing and bonding money. And yes, the point to be remembered, to put it another way, don't put all your money into one form of investment. The market isn't trying to take you down. The stock market has no idea about you or your plans. It has no agenda, and it could care less about yours. There are no magic solutions for investing success, despite what you may have heard from late-night infomercials or unwanted letters. There are no well-guarded secrets inside the sleeves of successful investors, and there are no secret passwords or handshakes. In reality, Only a little research and a strong understanding of the fundamentals stand between you and successful investing. Such fundamentals include how stock prices are determined and how to apply the buy low, sell high philosophy. You don't have to be a genius to succeed. A seasoned investor may have an advantage over you when you first start out, but you don't have to be a math genius, affluent, or the next Warren Buffett to invest in the stock market. When compared to purchasing a franchise or starting your own firm from scratch, the conditions for investing in the stock market are minimal. Just try to choose equities issued by firms you recognize in industries that interest you. This enthusiasm encourages you to keep knowledgeable about your investments. The qualifications for investing include researching the firms you're interested in investing in, which often entails reading their annual reports, which can easily be found by digging around their websites, and routinely setting aside money to invest. With time and investigation, you should be able to understand investment ideas. You understand 5th grade math means addition, subtraction, multiplication, division, or such basic operations. When it comes to making investments in the market, take your time. There is not now a pressing requirement for you to turn out and make an investment in the stock market. First things first, do your research. Make sure your objectives and expectations are reasonable, and figure out how to make the most of the information at your disposal. You can have a better understanding of the market by practicing with investing simulators for a while as part of your preliminary training before you enter the market to see how well you do. Have in mind that despite the fact that the stock market can at times appear to be merciless, it can yet be an exciting and potentially lucrative venture. Transparency. In every nation, there is a governing body that is responsible for overseeing the stock exchange. In India, this governing body is known as SEBI. The stock exchange, the level of transparency in the market, and investors' rights are all regulated and protected by the agencies that oversee the market. These principles are what allow the market to work properly. When an investor puts money into the stock market, not only his money but also his rights are safeguarded by the several regulatory agencies that oversee the financial industry. Because of this, they are protected from any form of fraudulent behavior that may have been carried out by the company in which they've invested. Because of this, the investments are even more secure, and the investors are provided with confidence and trust that nothing negative will occur. Now we come to a genuine concern that many people on the internet share. What happens when the stock market crashes? However, the good news is that there's no need to worry. In fact, we'll explain why it's perfectly fine not to worry when the stock market experiences a downturn. When the stock market crashes, it's normal to worry about what will happen to your investments, but there are good reasons why you shouldn't freak out when this happens. First of all, market crashes are a normal part of the market cycle, and over the long term, the stock market tends to recover and keep growing. Also, investors with cash on hand can buy stocks when the market crashes because stock prices often drop sharply during downturns. If investors buy stocks when their prices are low, they may be able to make a lot of money when the market recovers. Diversifying your portfolio is another way to lessen the damage that market crashes do to it. By putting your money into a variety of assets like stocks, bonds, and commodities, you can spread your risk and lessen the effect of a loss in any one investment. Thanks for watching. For more content, check out our channel and subscribe for updates. See you soon.